Okay, so welcome to chapter 6, which again goes a little bit more in depth on inventory, all right, as you'll see. Learning Objective 1 in chapter 6, you've seen everything in this objective from chapter 5, so it's just going to be a quick review. Learning Objective 2 is going to be the bulk of time that you will spend on chapter 6, because you're going to be introduced to what's called an inventory cost flow method. There are 3 of them that you will be introduced to that you'll need to know. And then when I see you next time, we're simply going to look at the very last objective, which is pretty light, how inventory is presented on the balance sheet. And then we're going to do a little bit of financial analysis. There's 2 ratios that I'll be introducing you to during our next class. And then, of course, the test will be released at the same time. So let's start. Most of Objective 1 should be all a review for you. Again, the idea is we're talking about a merchandising company, which deals with an account called inventory or merchandise inventory, but this is an asset account. When you get to managerial accounting, this stuff is going to come back. You're going to actually see this again when you go into the managerial accounting class, which is after this, because we will be dealing with inventory on a different level from manufacturing, because they actually create the goods. So they start with raw materials, they have inventory that's being processed, being made, and then once that is ready, it's finished, it goes part of their finished goods inventory. So we're going to be looking at that in Accounting 204, just so you know what's coming. We've talked about the different inventory systems, as you know, perpetual system, one that is continually updating its records. It's all computerized, things are scanned in. As people buy those, that's scanned out. And so the computer is trying to keep a very accurate record of what's left in inventory, et cetera, et cetera. But even with a perpetual inventory, they need to still take a physical. They still literally have to do a physical count at least once a year to make sure they're keeping track of any inventory that's been lost to other types of categories that you want. Of course, you want your inventory to be sold to customers, but sometimes inventory disappears in other ways. And so we'll get to talking about these a little bit more actually in chapter 7. And a periodic system is literally something in which you will physically count the inventory periodically. So usually at least once a month is typical here. And there you're counting the inventory that you still have, comparing that with the inventory you started with. And whatever is not there becomes your cost of goods sold. And so that's a physical counting system that we do. Again, it's not used all that much today unless the company is extremely small and doesn't basically computerize their inventory. But it is something, even if those bigger companies that do have the computer system working and running, you still got to sit down and at least once a year count what you've got. But the periodic system is counting what you've got pretty frequently. Okay, so those are the 2 systems. When is everything actually, when is the physical inventory done, the literal counting? Well, obviously when the business is closed, so you can actually don't have to deal with customers, and your staff can be busy physically counting the inventory. Or when business is so slow, they actually can do both. They can work with the occasional customer that walks in, and in the meantime, while there's no customers in the store, they can be counting the inventory. It's always done at the end of the accounting period. So in our case, like I said, at least once a year, even for those with a perpetual. But for those with a periodic system, they'll be doing it usually the end of every month. We talked also about the ownership of goods and, when that actually takes place, because some goods are actually in transit, which means you own them, but they haven't arrived to you yet. They're still in transit. They're still in the process of being transported to you. Well, even if it's a good in transit, if you own it, it's got to be part of your inventory. It's got to be part of your inventory. Why? Because literally speaking, you have legal title to those goods if it was part of the bill of sale or the terms of sale. And usually, most commonly, the term is FOB shipping, which means the ownership transfers once it gets shipped. Okay. Speaking of which, you've seen these before, FOB shipping point, FOB destination, how to determine who owns the merchandise. As you know, FOB shipping, the transfer of ownership happens when the seller boxes it up and provides it to the freight company to transfer to the buyer. At this point is when the ownership passes. Okay, so even though the buyer has not yet even gotten delivery of the goods at shipping point, they own the goods from this point on. So they have to, it's part of their inventory here. FOB destination, as you know, just the opposite, the seller still owns the goods even when it's boxed and transported. The buyer owns the goods literally when it gets to their place of business. That's when the ownership changes hands, and that's when it becomes the buyer's inventory, not the seller's inventory. But the seller still has to leave it in their inventory while it's in transit because technically they still own it. And the only thing that's really new is this idea of consigned goods, consignment. So in a consignment situation, you have agreed, usually for a fee, to allow another company to use your shelf space, either for that particular fee or for a commission on the sale of the goods. And this is actually more common. In a consignment, you don't own the goods. You are simply collecting a fee for selling them or for giving them the shelf space. This happens in supermarkets a lot. If you think about a supermarket, not every product in the supermarket is actually purchased by the supermarket. There are some where you look at the chip aisle, you look at the soda aisle. Basically, it's all rented space. Those are all consigned goods. You'll often see, a truck outside from Coke or Pepsi or Frito-Lay or one of the other chip types of Doritos, whatnot, coming in and stocking the shelves again. Why? Because those are consigned goods. The supermarket is simply collecting a fee for basically renting the aisle space to that. So it wouldn't be part of their inventory. Okay. If anyone has gone to an antique store, a big antique mall, it's all consigned space. It's all consigned space. So that's usually how they work. Okay. All right. And so we come to the end of our first learning objective here about the rules of ownership, and that's very, very important to get by here. So where we have has-been company, they are completing their inventory count. They have a total value of inventory of $200,000, but you've been given additional information listed below. And you have to tell us how this information affects the inventory. Okay, well, the first thing here is that has been included. So they included goods held on consignment. So again, in the case of consignment, those are not your goods. You don't own those goods. So they're not part of your inventory. Remember, inventory is an asset. Assets are, right, resources that are owned by the business. Right? Well, consigned goods are not assets. And so if $15,000 of consigned goods are included in this number, that number is too big, it should be lowered. The second thing here, we show that the company did not include purchased goods of $10,000, which were in transit. Okay, FOB shipping means that as soon as it hit the transportation company, the ownership changed to them. So here has been actually owns these $10,000 worth of goods, and they're not included in that number. So they need to be added into that number. And the very last thing here is the company did not include in the count inventory that had been sold, had been sold for 12,000. Well, if you saw, and it was shipping point, so it's in transit. You've already shipped it. It's no longer yours. The ownership is transferred at the shipping point. So if it's in transit, you've already shipped the goods. I don't know why you want to keep that 12,000 in your inventory. You don't own it anymore. So this would have overstated that a bit. So those are the rules, and of course, this is the proper type of thing. All right, so here we go. Back to our main screen just for a quick check-in. Questions on any of that stuff? We're good? No? Little staring contest going on? No? Come on, Ryan, I can take you out. Okay. All right, well, if there's none, we'll move on to the bulk, which is objective 2 here. I have these little, I think they're very small animals that are rustling through the leaves in the backyard here. So every now and then it'll catch my attention, like, what is that? But it's, squirrels and little fairy things. Okay, ready? Not too thrilled about those things. Okay, learning objective 2. This teaches you about the different cost flow methods for inventory that businesses can use. So you kind of know how it works from chapter 5, right? Businesses are always buying inventory and putting them on the shelf. Of course, they start with the beginning inventory at the beginning of the year, and of course, that's usually kind of a low amount. So they're always purchasing new inventory and putting those on the shelves all month long, all year long. So let's say that, I'll pick on Roman for a second since he has questions. So let's say Roman went into a sporting goods store and wanted to buy a new, backpack for some hiking type of stuff. Well, this sporting goods outdoor store has been purchasing. They started with a beginning inventory of 10 backpacks, and they've been purchasing 10 backpacks a month, every month, all year. He comes in, he buys one of them. Which one did he buy? Right. Well, that basically is the question that hits everyone. Okay, well, if a customer comes in and buys part of our inventory, and we've been buying this inventory all year long, which one did the customer buy? Right. Well, the cost flow method is going to help get the answer that we're looking for here. And the cost flow assumptions we will focus on, although there's technically 4, will be the last 3 that are listed here on the slide. the first in, first out method, the last in, last out method, and the average cost method. And so basically speaking, these this is what you're going to be focusing on in this part of the chapter. There is this is a legitimate cost flow assumption called specific identification, but we don't cover it in this particular class. And it's not widely used by many businesses. Maybe 10% of businesses use this. We're going to be focusing on what most of the businesses do. Okay, so we're going to go to our cost flow assumptions that we just looked at. You need to understand that if you basically looked at most merchandising companies today, almost half of them use this method called FIFO, first in, first out. It's also a really great name for an accountant's dog. Here, FIFO. Coming in next is the category that we call LIFO, last in, first out. LIFO is what a lot of accountants tell their kids to do. You don't get a LIFO. And so as you see, between the two of them, roughly 3 out of 4 businesses use one or the other. We will be introducing you to the average cost method as well, but we're going to look at one at a time. What do these mean? LIFO, FIFO, LIFO. What do they mean? Well, this is what it means. The first thing you need to know is you must have an inventory list in front of you. Okay, you must have an inventory list in front of you. So otherwise, none of this makes any sense. So step one, get your inventory list. This is a company called Houston Electronics, and their product is called an Astro condenser. Okay. And so here we have the product. At the beginning of January, they obviously use a calendar year here. They had a beginning inventory of 100 Astro condensers. They paid, right, the cost to the company. They paid $10 each for these Astro condensers. So they started the year with $1,000 worth of inventory. Okay. So this is how we would read. So this is the beginning inventory. This is what they started the year with this product, 100 Astro condensers. As you can see, a few months later in April, they went out and bought more inventory. They bought 200 more of these Astro condensers. Well, look what happened. When they went to purchase them and bring them to the store, it actually cost them $11 each. The cost had actually increased from $10 to $11 each. And so when they bought these 200 Astro condensers, they actually had to pay $2,200 for the inventory. Okay. But look, if you just stop right there in April, this company had 300 Astro condensers in stock, right? 300 total units after April, and they had $3,200 worth of inventory. A few months later, in August, they bought more Astro condensers. They bought 300 more. And again, look what happened. The price, their cost, the cost to them, this is the cost to the business, not what the customer paid for it. Okay. They might have charged the customer $30 for this thing. We're talking about the cost to the store. Went up to $12. So these 300 units now cost $3,600. Okay. And look, after August, if you looked at just stopped at August, they had 600 of these Astro condensers, and they ended up forking out $6,800 worth for inventory. That's what they had for inventory at that time. Lo and behold, at the end of November, they went out and they bought 400 more. Apparently, Astro condensers make awesome stocking stuffers. Here we have they're $13 a piece. Again, every time they go and buy more inventory, the cost of each of these units goes up. So they end up forking out $5,200 for this inventory purchase. And now at the end of the year, the total units that they purchased for the whole year was 1,000. And it cost them a whole $12,000 for all of that inventory. These are important. These are important figures to know. Okay. These are very, very important figures to know. These 1,000 units are all of the units from beginning to all the purchases added together. This $12,000 is the beginning amount of inventory plus all the purchases added together. Okay. That's the total available for sale. Of course, as I taught you in the previous chapter, only two things can happen to inventory. You either still have it in your store at the end of the period, in which case this is the end of the year. If it's not there, you assumed it's been sold. Okay. So from this total, two things you're gonna be able to tell two things. How much you still own, that's your inventory. In this case, of the 1,000 units, they still own 450. So there's still 450 units in the store. So what's not there is 550, the difference. So those are the units that have been sold. The question is, going back to our cost flow assumption here, how do we know what the cost of goods sold is? Which 550 units did this company sell? Did they sell the ones from the beginning? Did they sell the ones in the middle? Did they sell the ones at the end? How do they know what to use? Well, they have to select a cost flow assumption. And every company has the right to choose the cost flow assumption that works for them. So let's see then how FIFO works. FIFO means first in. Well, first in terms of when you look at the list, which are the first goods that you see? Well, the first goods that you see are the ones that are in the beginning inventory. Those are the first ones. All right. So let's go back here. The first ones in are at the top of the list. So these are clearly the first ones in on the list. January, these 100 are the first ones. So under FIFO, the first ones in are assumed to be the first ones we sold. First out simply means we've sold them. They're out the door. So FIFO, in essence, calculates the cost of goods sold by looking at the first ones in and making those the first ones on the cost out. So this is how it looks. Your book explains it this way. Okay. Again, this is the same exact inventory sheet. You have to do this with an inventory sheet. Otherwise, you don't know what the heck you're doing. Okay. You have to have an inventory sheet in front of you to sit and do this thing. Okay. You can't do this by guessing. And of course, here's the total amount of the cost here. So of these 1,000 units, we know how your book explains it is what's left in inventory. What's the ending inventory? Well, first in, first out means that if you sold 550, which is what they did, right? 550 sold. Under FIFO, the first ones on the list have already been sold. So these 100 are part of that 550. These 200 are part of that 550. Of the 300, 250 are part of the 550. The other 50 are still in the store. So ending inventory is 450. The 50 from August that's still left and all of the November purchase are still in the store. So the first thing they do here is say, okay, all of the November units are still in the store. Those are the $13 units, $5,200 of inventory there. 50 units from the August purchase are left in the store. They're the $12 units, $600 more dollars. So we have $5,800 left of inventory. Well, if you start with $12,000 of inventory of Astro condensers. And at the end of the year, you have $5,800 of the Astro condensers left. You sold the rest. The rest is cost of goods sold. That's how the book shows you. Let me show you how to check whether this number is correct. Okay, and you all know how to prove your answers, right? So the cost of goods sold is the total of all the ones that have been sold. So of the 550, this 100 has been sold. So it's $1,000 to start. 200 is also sold. So we have 300 units accounted for of the 550. And that's $3,200 worth of goods sold. We need another 250. 100 plus 200 plus 250 will give you the 550. So 250 times 12 is 3,000. 3,000 plus 2,200 plus 1,000 is 6,200. Okay. So you can prove it either through what your book is showing. Your book says get the ending inventory and simply subtract the difference. This is what you started with. This is what you've got left. The rest you sold. But you can also do it the way I had showed you here, that you can actually prove your cost of goods sold is 6,200 by literally picking out the ones that were sold, totaling the number. Okay. This is a beautiful graphic. I don't know if you like graphics. I actually really like this one. It's on page 274. I actually have this in a full-blown painting in my guest room. It's really beautiful. As you see here, the boxes in the middle represent the purchases. So actually, this is the beginning inventory. This is your April purchase. This is the August purchase split into two parts. Okay, the part that's been sold and the part that's still there. And this is the November purchase. So what they do here is they show graphically that this is the stuff that's still owned. Again, inventory is an asset account. Specifically, it's a current asset. All of this amount represents those that have been sold. And so the $6,200 represents your cost of goods sold. Cost of goods sold is an expense account. All right, cost of goods sold is an expense account. So that's how they determine it. Okay. Last in, first out, what we call LIFO, looks at that list in reverse. The last ones on the list of inventory is the first ones that they cost out for cost of goods sold. Okay, so the very latest ones on that list are used to determine cost of goods sold. This is another way of looking at it. Okay, so let's go back to our list, shall we? It's the exact same list that we've been dealing with. Okay, 1,000 units, $12,000 total cost of those units. That's the value of our inventory. Okay. So we sold, as you know, 550 units have been sold. The other 450 are still in ending inventory. Well, which units are in ending inventory? Well, if you sold 550 under LIFO, the last ones in, so this is a bottom-up approach. The last one are the 27th of November. The November ones are the last ones. So the last ones in are the first ones out. So these 400 are gone. They've been sold. And half of these are gone. They've been sold. They're part of that 550. So what's in the store? Well, the other half of these are in the store. All of these are in the store. And all of these are in the store. 100 plus 200 plus 150 is 450. So this is what your inventory list looks like. The 450 is broken into the January amount, the April amount, and half of the August amount. You know what the unit cost is, so you multiply it across and total up. So what you have left is $5,000 of inventory. Again, inventory is your asset. That's the value of that asset. Well, if you started with 12,000 of inventory and you have 5,000 left, You sold the rest, 7,000. How can you prove that you sold 7,000? Well, you can prove it by looking at the 550 you sold. 400 at 13, so you sold all of these. These are sold, and you sold half of those, so half of these. So 5,200 plus half of this is 1,800, gives you the 7,000. That's how we know we did it right. Again, as you notice here, of all the goods available for sale, it only ends up in two places. It's either still with you, which is your asset, or if it's not with you, it's expensed as cost of goods sold. Only two things can happen to inventory. This allows us a way to figure out how to calculate those numbers, how to calculate the value of ending inventory, how to calculate the value of cost of goods sold. That's what LIFO and FIFO and the next one is going to teach us. That's all. And businesses have their choice. They're not forced to use one or the other. They can choose which is best for them, their particular business. This is another beautiful graphic. I actually have this painting in my hallway. As you see, again, same thing, beginning inventory listed here, each of the purchases. This August purchase is split in half and half, right? And then the November purchase. So as you see, the November purchase and half of the August purchase have been sold. They're part of that 7 grand. They're part of the expense of cost of goods sold. The other half of the August purchased, all of the April units and the beginning inventory are still with us. They're still part of our inventory. It's an asset account, right? Average cost is actually the easiest to figure out because it's simply a weighted average of all the units. So this is how it works. First of all, again, you're looking at an inventory list. You can't do any of this stuff without an inventory list. I can say that a lot. You have 1,000 Astro condensers. And as you see here, you spent $12,000 to buy 1,000 of these. And so first is, what's your average cost for each? So the average cost for each of these units is 12 bucks. $12,000 of inventory bought you 1,000 units. Thus, each unit was 12 bucks average cost. You've got 450 in the store still with you. They average 12 bucks each. That's your value of your ending inventory. Again, that's an asset, ending inventory. Cost of goods sold is clearly the difference. $6,600 is the difference, but how can you prove it? Well, you sold 550. So 550 times 12 will get you that number. And this graphic is one of my favorite. I actually have it over my bed in my bedroom. It's really beautiful. I love that tank. Here it shows the amount of money that you spent in total and the number of units it bought. Gives you an average cost per unit. You know you have 450 units with you here, and you sold the other 550. You can simply multiply it across. So again, ending inventory, the actual account is inventory. That's an asset account. Cost of goods sold is an expense account. So it's important to make sure we know the difference. So what would you use if you were a business? So again, it's totally up to you, but let's look at Houston Electronics with those Astro condensers that we looked at. Obviously, they have sales revenue. They have cost of goods sold. I want to look at the gross profit. Look at the gross profit. This is something that companies look at. Okay. What I would suggest, how companies make the decision, which method to use. Again, these are just methods that they can use to get their cost of goods sold and their inventory calculated. I would use the method that gives me the largest gross profit. So if I used FIFO, 12,300 is the largest gross profit. LIFO, it's 11.5 and 11.9 for average cost. So I would, if I was Houston Electronics, off the bat, I would use FIFO. Better still, the company looks more profitable as well on the net income level that provides you with the highest amount of net income. So again, these gross profit margins, as we talked about in chapter 5, that statistic of gross profit margin is an important metric financially that's used. It's an important statistic. And so is the profit margin, which is your net income divided by sales. You want that to be as high as possible for your industry. And so I would say that FIFO gets this company there much, much better than LIFO average cost. Could they use LIFO average? Yes, it's all perfectly reasonable within the rules of GAAP. Generally accepted accounting principles allows every merchandising company to pick the method that works best for them. But I would go ahead if I was Houston. I would use LIFO. I would say if they use FIFO. If they use LIFO, they would have a much lower net income, and I would say, Houston, we got a problem. If I was NASA related, I'm really trying here. I just thought about that. That was kind of cool. Anyway, what companies would use LIFO? Well, companies in which the products go down in price over time. And so they might start off as very high priced, but as the months wear out, as the years go on, they get lower and lower and lower in price. So perfect example would be electronics firm. You know that when flat screen TVs, even the curved TVs came out, they were very high priced, but now they're much more reasonably priced. Same thing with phones and other types of gear. Once they hit the market, they're usually very, very high priced. And then you have prices drop over time. What type of dealers, Michelle, are we talking about? Oh, car dealers. This is interesting because car dealers are really franchises of the manufacturer, and they're certainly not standalone businesses. Like Walmart, for example. Walmart has to deal with manufacturers because Walmart doesn't make anything. Walmart buys everything and they resell it. Even they have their own brands. That doesn't mean they make it. They hire a company to make it. So you can tell what their cost of goods sold is very, very clearly. You can't do that with an auto dealer because in order for you to have a GM dealership or for you to have a Ford dealership or a Chrysler dealership, that's a franchise of the main corporation. So the corporation is making the car itself, and then through its franchises, they have to buy those cars, by the way. Through the franchises are selling them. And so you really don't have an independent cost of goods sold here to look at. It's not really the best way of saying that. Although I would agree with you, I've been fortunate enough in my lifetime, and now that I'm in my going past my mid 50s here, sadly, I've had a number of different cars that I've purchased, almost all of them new, that I've never paid over $20,000 for. And so I would say, and I'm still using that philosophy today. And my latest car I got was actually, I have a nice little sports model Civic, and I paid the cheapest amount that I could. I mean, I was shocked at the deal that I got. So I do think that, yes, car prices have stayed relatively low over time for a lot of different models, unless they're all souped up. If they got the latest, even if you move, if you sneeze, a bell or a whistle sounds, that technology has driven the price of cars up quite a bit. But in general, you can't usually use a car dealer for this type of, and look at it very clearly. Look at it very clearly. Okay, so let me move on to our do it exercise here. Here we have the accounting records for Shumway Ag Agricultural Implement. Okay, so this is Shumway, and this is their accounting records. They have beginning inventory, 4,000 units at $3. Okay, Gio has a great question here. They have to use the same method. Walmart's it's when you have a multinational corporation like Walmart, because Walmart does a lot of business in the United States, clearly, but they have Walmart stores around the globe. For their US stores, all their US stores, they have to use one method. So, and I think they use FIFO for their US stores. But for their other stores internationally, they don't have to use the same method. So it's kind of an odd thing for large companies. So, but generally speaking, you do have to commit to one method, at least for US reporting purposes for GAAP. Okay, good question. All right, so let's get back to Shumway, because there's going to be Shumway of dealing with this. Man, I'm just roaring today. I don't know. So anyway, we have beginning inventory, because this company started with already 4,000 units at $3. So they had $12,000 worth of inventory to start. Looks like they purchased another 6,000 units of inventory. But as you see, that went up to $4 a piece. Okay. So again, what we're looking at is when it comes to sales here, that piece comes second. What did they sell? Well, they had to sell things that they owned. So it all starts, first of all, with understanding that this company started or had a total of 10,000 units for sale. The 4,000 units they started with, plus the 6,000 that they bought. So the total available for sale was 10,000 units. So of the 10,000 units, they sold 7,000 of them. Okay, leaving them with 3,000 in inventory or ending inventory. So the question now becomes, what's the question about? They want cost of goods sold, because the question could be two things. They could ask you about the cost of goods sold, or they can ask you about the value of the ending inventory. Because of the $10,000 of the 10,000 units, some of them have sold, clearly 7,000 units are sold. What's the value of that? This is what they sold it for. This is not their cost. Okay. And the 3,000 units they have left, what's the value of that? So you have to know how to do both, which is why it shows you both in throughout the book so far. So cost of goods sold using FIFO. So FIFO, again, first ones in are the first ones out. So if they sold 7,000 and you looked at this list, and it's a very short list, you know that these 4,000 units have been sold. They're gone, right? Go. Well, 4,000 of 7,000 need 3 left, right? So of the 6,000, 3,000 are gone. Right. So 4,000 units at $3, 3,000 units at $4 make up the 7,000 units they sold. And so the cost of goods sold, sorry, for FIFO is $24,000. The 4,000 units at 3, which is the beginning inventory, again, first in, first out. And then the 3,000 additional units, because we need to get 7,000 total at $4. So in this case, it works out quite easily. The next one is, of course, same question. Cost. Well, let me go back to that one for a second. So that's the cost of goods sold. What about inventory? What's the value of the ending inventory? Well, the ending inventory, what do they have left? They have 3,000 units at 4. So they have $12,000 worth of inventory left. 24,000 is the cost of goods sold. Yeah, and 12,000 is still in inventory. 3,000 units are left. Okay. Again, they started with 10. They sold 7. That's the cost here for them. They still have 3. That's what's left. You could be able to tell, you should be able to figure out both parts. Just read the question as to what part they are asking you for. Are they asking you for the cost of goods sold, or are they asking you for the ending inventory? Because both of them have a value. Okay, both of them have a value. Okay, so we're looking at LIFO. So again, there must be some way of figuring this one out. Well, again, you know you have 10,000 units and you sold 7,000 of them. Under LIFO, which ones did you sell? Well, LIFO is bottom up. So these 6,000 units have been sold, and you need 1,000 more units to be sold. And so when you look at that, 6,000 units at $4 a piece, and you need 1,000 of these units at $3, 3,000. Your cost of goods sold, 27,000. What's remaining in inventory? Well, you got 3,000 left at $3 a piece. You got $9,000 of inventory. Okay. So again, if you use LIFO, FIFO, whatever, you can calculate the cost of goods sold, and you can also calculate the ending inventory. Okay. And then the last is average cost. Well, to get an average cost, you need to find out the total amount of money you spent on the inventory. So you spent a total of $36,000 of inventory. That $36,000 bought you 10,000 units. So each unit is literally $3.60. So you need to first figure out your average cost for each unit. And then, of course, okay, your book does it this way. You sold 7,000 units. We don't even care about the price that they sold that, because we're not calculating revenue. That would be revenue. We're calculating costs, in this case, cost of goods sold. Well, you can say 7,000 times 360, and you'll get this. Or what your book has been showing you, right? The total amount of inventory for sale minus the value of the ending inventory. Well, there's 3,000 units left. This should be units, not dollars. There's 3,000 units left, and they're all worth $3.60, right? So calculating that out, it looks like it's about $9,800 or so, roughly. And that leaves $25,200 as your answer for cost of goods sold. So you can prove the 25,200 in 2 ways. Okay. Oh, sorry, it'd be 11,800. My bad. Okay. And that, my friends, is the show. Questions?